everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Is this going to be another case of deja vu all over again? Obviously I'm referring to another incredible rally in the Treasury market, much like investors saw in the fourth quarter of last year. And as was the case then, it's still the case now. This Treasury rally needs to be validated. So let's take a step back for a minute to that Q4 plunge in Treasury yields. And the catalyst for that move were the notion of a pivot in Fed policy from rate hikes to rate cuts, brought about by improving inflation data and potential softening in economic reports. Now, in hindsight, we all know how that turned out, and that's the rally was not validated, and as a result, Treasury yields reversed course in a visible fashion, reaching their 2024 peaks in about late April. So let's fast forward to the present, where the decline in Treasury yields is actually eerily similar to that fourth quarter experience. And for this podcast, I want to concentrate just on the Treasury 2 and 10-year yields. And as I mentioned, technically, the 2024 peaks for each of these maturities actually occurred in late April, but I wanted to highlight the yield movements that have transpired just a little over the last 2 months. Now, taking the 2-year first, from its late May level, the yield dropped at one point by an incredible 132 basis points, bringing the intraday low to 365. Now, of course, most of the headlines are reserved for the 10-year note, and in this case, the yield plunged 94 basis points for an intraday posting of 3.67%. For the record, in Q4, the decline in yields for the 2 and 10-year notes were 110 and 120 basis points, respectively. So interestingly, while the starting points in terms of yield levels for this most recent rally were a bit lower than the Q4 episode, those low watermarks I mentioned before were visibly below those readings, especially for the Treasury 2-year note. So the 2-year low point was about 50 basis points under the prior bottom. And why is that noteworthy? Well, let's go back to what I talked about a week ago, I think it was, where I discussed Treasury correlations to the Fed funds target range. And if you recall, the Treasury 2-year yield is very positively correlated to overnight money. So at its low point, the 2-year was discounting a very aggressive rate cutting policy from the Fed, considering the midpoint of the Fed funds rate was still 5.375, 5 3/8%. So this is where validation comes back into play. Did it make sense for the Treasury 2-year yield to be an eye-opening 173 basis points below the Fed funds level? And given price action as last week progressed, the market's answer seemed to be definitively in the negative. And the yield did move back above the 4% threshold. Not by a lot, but it did move above 4% to some extent. So yes, disinflation appears to still be intact, but the economic data do not, at this point anyway, point to an imminent recession or hard landing. In fact, the ISM services gauge that was released last week came in better than expected and above that 50 line, which is the line of demarcation between expansion and contraction. And perhaps more importantly, the weekly jobless claims number fell more than projected, and that completely reversed the prior week's increase, which, if you may recall, helped give rise to all of those labor market concerns. There was also similar yield movement for the 10-year Treasury as the rate here bounced 30 basis points off its low water mark. So while market expectations for a 50 basis point rate cut from the Fed in September has modified, it's still being viewed as a better than a 50% chance as I'm talking to you now. So while the Treasury 2 and 10-year trading ranges have been moved lower, if the data don't point the Fed in the Treasury market's direction, this most recent rally could once again not be completely validated. So I'm going to leave it there. I hope everyone has a great rest of the week and be well.